Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, Head of Investment Strategy. With an objective to empower you with investment insights, on this program we discuss various perspectives that are shaping the global investment landscape. Last week, as part of our 2023 Outlook podcast series, we discussed our 2023 investment strategy outlook. Now, we turn to individual asset classes, and this week we focus on fixed income. After the dismal performance in 2022, we believe the worst may be behind for fixed income assets. We upgrade fixed income to an overweight from underweight on prospects for better risk-adjusted returns. Of course, timing the peak of the interest rate cycle is difficult, but we believe that it will happen at some point this year, allowing fixed income assets to perform well over the medium term. Moreover, once inflation cools as we expect, correlation between equities and bonds could once again turn negative. With a starting point of higher yields and potential negative correlation with equities, fixed income could once again become a credible alternative to equities. Then, the real question is, what investors should own within the asset class? For this, we turn to Prerana Seth, our fixed income strategist. Hi Prerana, welcome back to the show.
Thank you. It's good to be back and wish a very happy new year to all our listeners.
Prerana, while we move fixed income from an underweight to overweight in our portfolios, we have not made any changes to our preference within the fixed income space. Could you touch upon that a bit?
So our preference within the fixed income space remains the same in 2023, but with a stronger conviction on our duration call. We believe that 2023 is likely to be the year of duration and maintain our overweight stance on the 7 to 10 year segment of US Treasuries. The 10-year US Treasury yields tend to peak much ahead of the Fed's terminal rate of the hiking cycle. Also, the 10-year US Treasury yields have never crossed the peak Fed fund rate in the past tightening cycles. In addition, while 2022 was the worst year for bond volatility amidst inflation and Fed policy uncertainty, we believe that bond volatility will stabilize in 2023 with prospects of more clarity on Fed policy and reduced inflation uncertainty. And lastly, 2023 will not only be the year of duration but also the year of US Treasury yield curve steepening, where rates will decline across the US Treasury yield curve but led by the short end rates. The 10-year and the 2-year US Treasury yield curve begins to steepen with the Fed pause, and the steepening picks up momentum once the Fed starts to cut rates. Since bond yields are likely to decline across the US Treasury yield curve due to the duration effect, we believe it should benefit the long-dated US Treasury yields more.
How about developed market corporate bonds? Do you think prospects for DM corporate credit will improve in 2023?
So DM corporate bonds have suffered losses in 2022 with the developed market investment grade being the worst performer. Definitely US investment grade valuations have become attractive, and this is not only versus fixed income peers but also versus equities. In fact, the US investment grade yield versus the S&P 500 dividend yield differential is now at the widest level since the global financial crisis. But we still remain neutral on US investment grade and wait for opportunities to add exposure once the recession risks subside and stick to quality. We hold a more positive outlook on European investment grade relative to US investment grade. This is because the European investment grade spreads have widened more than US investment grade spreads and are also now fully accounting for the recession risk in Europe. Moving to high yield, in US high yield, we believe that the worst may not yet be over given their sensitivity to equity market volatility and tightening of US financial conditions, and also the likelihood of sharp jump in default rates in the event of an economic downturn. So we still maintain our underweight stance on US high yield.
Let's now turn to emerging market bonds. The asset class was negatively impacted last year due to rising rates, higher bond volatility, and tighter financial conditions. Do you believe there is light at the end of the tunnel now?
Definitely the prospects for emerging market US dollar bonds look better compared to 2022, with our expectation of waning dollar strength and pickup in China growth momentum. Emerging market dollar bonds valuations are also looking attractive versus peers, and the emerging market and the developed market growth differential is forecasted to widen in 2023. And last time when the growth differential was this wide was in 2016, when the emerging market dollar sovereign bonds had recorded strong annual gains of around 9.3%. Having said that, emerging market bonds are still likely to face a rocky path to recovery. Besides the idiosyncratic domestic issues, external headwinds remain, particularly in terms of their vulnerability to the US financial conditions. So we still maintain our neutral stance on emerging market dollar bonds and emphasize on remaining selective within the asset class, sticking with countries backed by strong fundamentals, which includes high-quality GCC sovereigns and Oman. In emerging market credit, we retained our preference for Asia credit through our overweight stance on Asia investment-grade bonds. The positive turnaround in China's credit impulse is likely to prove supportive for the sector.
Well, Prerana, thank you very much for joining us on this program.
Thank you, Kishore.
Thanks for listening. We hope you found this podcast useful. If you did, please do share this and other episodes with family, friends, and colleagues. For more information, please reach out to your contact at ADCB. You can also log on to our website at www.adcbam.com. Stay tuned for more episodes of our 2023 Outlook podcast series, where we discuss outlook for other asset classes including equities, currencies, and alternatives. You were listening to the Global Investment Insights podcast from ADCB Asset Management. My name is Kishore Muktinutalapati.